And then going back to your first point, and by the way, this was a massive goal. So I'm trying to like unpiece sort of components of it. You were talking about the finance layer and actually utilizing better financial products to improve like cash flow and decrease, I think you said, interest rates. Just want to walk me through that a little bit of like the way that you're approaching it and how you're going to sort of implement that through 2023.
Yeah, so most noticeably, it's a higher interest rate environment right now. It really is. And I think just refinancing could be a potential strategy to improve the profitability and cash flow of a property portfolio this year. Like just harassing banks and finding the best deals and brokers could actually be the thing that makes you the most money in 2023.
Totally.
So what I've been looking at here is that in my experience, and this could change, is that if you have loans on principal and interest versus interest only, they normally charge you like 0.5%, maybe even 1% with some banks to be on interest only. I had some loans sitting on interest only where I didn't need the cash.
Yeah.
So this is where we did a refinance, potentially even got some cash out, and then refinance it to principal and interest, sitting that cash in an offset account to bring down the interest rate on the loan. And there was one that was like 0.8% just for that change. So nearly 1% difference in the loan for making that change. Now, on that property, the loan was like $500,000. So 1%, like that's $5,000 a year.
Huge change.
So that's $100 a week. That property is now more profitable because of that loan restructuring.
Not to mention that you're actually paying down the principal on top of a cash flow positive portfolio on top of a lower interest rate. I think that idea, which is why I wanted to cover it, is just not covered enough. It's almost like especially for myself with everything that I've been told, it's like property investors primarily focus on interest only and then get to the end of the 2-year, 3-year interest only period. And guess what, Charlie? We refinance again. And then we go and get another interest only period, as opposed to saying what other financial products are out there to actually support my goal and where I'm at and where I'm trying to get to. Because it could be, I'd argue that there could be a point where I get to a similar situation and go, you know what, I think P&I might be right for this season of where I'm at.
I completely get this is a very personalized question. Like finance setup, depending on your circumstances, is very, very different. Like it can be wildly different. So I'll share a couple more here. Is like I want you to imagine you've got a property in a trust as well, where trust is notoriously where they charge higher interest rates as well. There's totally the notion of refinancing a property that's maybe in your personal name that's on a lower rate, taking capital out and then refinancing a property in a trust to put that money in to have lesser loan on the higher interest rate trust. So just in context is like you could increase your debt in your personal name on a lower rate and decrease your debt in a trust to make sure that you get a differential as well. So just some of the strategies you can look at. And I think of like, Dave Ramsey's like debt snowball. He's like, if you've got high interest debt on credit cards, pay that down first. And it hit me pretty apparently that you can kind of do that with property as well. Like you can refinance your loans to, for example, have a higher amount of debt in your personal name and lesser debt in trusts if that serves your purpose. That's very individualized and won't work for everyone as well. But I hope it can get people's minds turning to the idea of like what loans and sizing and depending on what structure they're in can make a huge difference to the profitability and cash flow in a portfolio as well.
But it's actually interesting. As I acquire more properties, my awareness of difference in rates and difference in products continues to increase. And so I can imagine for yourself where you got like 11 properties and you'll see like this one property where like the interest rate is like super high. It's like 7%. You're like, you outlier, come back here. And you go
May have had one of them. If you think I had a property on interest only in a trust and I was like, you are shitting me what they're trying to charge me on this, right?
What are you doing? Yeah, what are you doing?
Completely.
So then, yeah.
So these are the things you can start to do in this consolidation phase. Like as the accumulator, you become less orientated on this. You may obtain any finance deal. Like, yeah, I'll take 10%, just buy a property. But it's like, and we did, to be clear, like we took on some less than ideal loans. But it's like when you get to this stage and you're starting to optimize, you start to pay more attention to this because when you've got a portfolio of my size, you can start to think about, well, these 1% changes, like they're significant. Like they're really significant. And just one more point on this is I used to have this really, I'll call it irrational fear of like the idea of I didn't want the bank taking the principal and locking away that capital. But you get to a point where paying down debt starts to become a part of the strategy. And you completely acknowledge that you can always get equity out or refinance or do other things to access that capital should circumstance prevail. So that's how I've been thinking about it anyway.
All right, fellow property investor, if you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.